The 2017 tax legislation has significant implications for all businesses. That's why KPMG has created this video series, Tax Reform, Big Changes, Important Questions, to help you prepare. Today's question is, once you have a qualified trade or business, how much do you benefit from the new deduction for certain business owners? This seems like a fairly straightforward question, but the answer requires some deeper digging. Taxpayers will also need to consider two sets of regulations: proposed regulations that were released in August of 2018 and final regulations, along with other guidance, that were just released on January 18th of this year. For their 2018 returns, taxpayers can rely on either set of regulations, but they have to pick one or the other. They cannot pick and choose rules from each set of regulations. After 2018, taxpayers have to use the final regulations. And while there is more guidance, uncertainty still exists about certain aspects of the deduction. So, even if you previously considered how Section 199A might apply to your situation, it is a good time to revisit if you're eligible for a Section 199A deduction in light of the final regulations. If you do have a qualified trade or business, the benefit may be 20% of the amount of qualified business income. But of course, it's not that simple. The good news is that both sets of regulations provided some specific answers to some specific questions. First, with respect to the qualified trade or business, both sets of regulations address whether certain amounts will be considered qualified business income or not. For instance, ordinary income on the sale of a partnership interest may be qualified business income. However, the list of items excluded from qualified business income is longer and includes Section 1231 gains, interest on working capital, and certain payments to partners for capital or services. And even if you have qualified business income, limitations for wages and qualified property, certain tangible depreciable property, must be met for each trade or business, subject to specific aggregation rules. So, you will need to determine the amount of wages and qualified property attributable to a trade or business and the owner's share. This will require additional work, particularly the amount of your qualified property, which requires you to determine the unadjusted basis immediately after acquisition of certain property. The work is important as it will determine if there is a cap on your ability to benefit from the 20% deduction. There may be dramatic differences in the determination of an owner's share of qualified property based upon the proposed and final regulations. So, additional time may be needed for 2018 tax return preparation to compare the various outcomes. As an important side note, there are special rules with respect to income from certain publicly traded partnerships and real estate investment trusts that generate qualified business income without limitation. It will be important to isolate these numbers for purposes of determining the 20% benefit. Bottom line, it's complicated. Information will need to be gathered, determinations made, benefit quantified. New investor reporting will be required. Want to know more? Watch one of our other videos on 199A for more information, or visit KPMG's tax reform webpage, read.kpmg.us/tax-reform.